All right, we're now recorded. So I want to start off and welcome everybody to tonight's presentation. My name is William Mucker. I'm a client executive with Camaplan. Today, our presentation is Scaling Up Your Single-Family Business with GSP REI. We have some very special members from that company to present to you tonight. I'm going to introduce them right after this brief introduction. So to start off, there's no such thing as a good webinar unless you have a good disclosure to go in front of it. So this was put together by some clever attorney somewhere just to basically let you all know that we at Camaplan, we're not attorneys, we're not CPAs, we're not financial advisors. We can't give any legal, tax, or financial advice because we're not licensed in those areas. So whenever you're thinking about a major movement in one of those fields, please reach out to a licensed professional. Feel free, if you're a Camaplan client or if you're interested in becoming a Camaplan client, please feel free to bring in your team of professionals and have us on the line with them just to make sure everything's structured just the way you need it. Also, we don't endorse anything. We don't sell anything. This is all neutral and for educational purposes. And if you have any questions after the presentation, here is my contact information. I can be reached from any of these emails or phone numbers. You'll get a live representative who will get your question and then transfer you directly to me or to another representative that's best able to help you. For this presentation, we're going to be waiving $50 application fees for anybody who is interested in either opening up another account with Camaplan or opening up their first account, including family, friends, opening up Roth IRAs for your children, so they can get started on tax-free investing early in their investing life. And last but not least, I'm going to introduce our special guest today. With us today, we have Ron Lockhart, who is the founder of GSP REI. We have Peter Neill. He's the Vice President of Investor Relations for REI, or for GSP REI, excuse me. And then we have Wade Carroll, who manages the entire note purchasing cycle, including the acquisitions, loan workouts, and modifications, foreclosures, and disposition and pricing. Wow, that's a lot of stuff, Wade. So I'm going to pass it over to them. And I'm not sure if you guys have this looped into your presentation, but what does GSP actually stand for? And if it's somewhere buried in the presentation, you don't have to answer it now. I'm just curious.
Oh, that's a good way to kick it off. And thank you, William, for the introduction, and thanks for having us on today. GSP stands for German Short-Haired Pointer. So the three of us are big dog fans. Ron, you had 2 GSPs when we met. Wade, you've had them your entire life. I think you have one now. So GSPs have been something that is very close to all of our hearts. We're all dog lovers. So in an effort to come up with a name that we all liked and kind of, GSPs are hunting dogs, so they're very energetic when they get onto a scent or when they get on to, what they're going after. They don't hold up, they'll go for it. So very aggressive. So it kind of made sense for us, and that's certainly the way we are when it comes to acquisitions, when it comes to executing. So we went with it, and two, it didn't pigeonhole us into any one strategy. Right now and this is something we'll talk about in the presentation, but right now we focus on workforce and affordable housing. Middle income's another way to put it. So we like to stay in that, middle class, working type of people. We like to stay in those areas and with those tenants. So that's the strategy we like now. It makes sense for the market. I think COVID, but we'll talk a lot about right now, has definitely made this in my opinion, the #1 strategy in real estate at the moment, just having to do with supply and demand, that kind of thing. So that's what we didn't, but we want to stay flexible too. We have a lot of awesome resources and experience on the team. So we do look at the market, and if things change, we want it to stay flexible. So we didn't want to be just the note company or just the rental portfolio company or something like that. So we went with GSP, dogs, and something we all love. So that's the story behind that.
That's awesome. I love it. Very creative. So Peter, you have the controls now. This is your show, and if I didn't mention it earlier, I think I did, but just in case, we are leaving room at the end of today's presentation for question and answers. So feel free to put your questions in the Q&A section, and Peter or Wade or Ron will be sure to answer your questions by the end of the presentation. That's all you, Peter, and it's GSP.
Okay, awesome. I just popping up our website. I just wanted to show some things there while we go over the presentations. I hope this. There we go. Hopefully everybody can see that. So as we just said, we are GSP REI. Ron founded the company. Ron, we'll get into your introduction and Wade's introduction. Maybe we'll start with that. So if you guys don't know, I'm Peter Neill. My main job in GSP and just in life in general is building relationships with amazing people. So I have the honor to work with our fund investors that invest into our companies. So that's my main job, marketing and investor relations. And Ron is on the construction and property management side, the acquisition side, but also the CEO. He kind of directs the entire vision of the company. As William said, Wade is on the note side of the business, but has a very diverse background and has managed hundreds of single families over the years. So Ron, Wade, how about we just start with a very short, brief introduction, a little bit about your history and why you are people that should be talking about scaling up a single family business portfolio, that kind of thing.
Sure.
Let me start with you.
Can you hear me okay?
Yes.
Okay, sure. First of all, thank you all for taking the time to listen to us. Hopefully we can give you some good insight and be helpful here. I've been in the real estate business for over 20 years. I started out, and I'll try and be brief about my background. I started out on the construction side in my mid-20s, and by the early 2000s, had moved over to the investment side. We were purchasing for our own portfolio, small multifamily, and when I say small multifamily, 2-unit, 3-unit, 4-unit. It was always a space that we felt comfortable with. After about 3, 4, or 5 years of being in the investment side, I also became a partner in a real estate finance company in New York that did commercial and residential real estate finance. So while running both the investment side of our business and also being involved in the finance side, I got a pretty good look at all the different facets of the real estate business. After the 2008 collapse, we fortunately weathered that storm about as well as could be expected given the situation. I also got involved on the consulting side of the business. So we continued to be investors, but we would invest alongside institutions that we were consulting for that didn't have arms. Example, have a real estate division. So we assisted them in their master plan, acquisition, and execution. As in our current form, GSP REI, going back a few years, we saw an opportunity in the workforce and affordable housing space that there was a real gap that needed to be filled and still needs to be filled. And Wade, who you'll hear from in a moment, he's been a partner of mine for about 2 years. And through Wade's experience with government services entities and access to certain government programs, it was a good marriage of skill set. And so, as Wade can talk to his background on the government side, his relationships with the government side, that's been a big key for us from an inventory standpoint. So that takes us to where we are today, and I'll turn it over to Wade.
Wade, you good? Did you unmute yourself? All right, I'm not hearing Wade. Let's move on though. I'll shoot him a text, see if he's having some technical difficulties. First thing I want to hop into before we get into the meat and potatoes on scaling a single family, and I said business instead of a portfolio, because I think coming from that, the business foundation is a very important way to look at it if you are looking to scale up the rental portfolio that you have now. So I think it's very important to look at I look at real estate in three different ways, and especially this business. So there's raising capital, there's acquiring assets, and then there's executing effectively on the strategy. And we're going to get into those three areas and how it's in order to scale up effectively, you're constantly dancing between those three spaces: raising capital, acquiring assets, and executing on the strategy. So before we get to the meat and potatoes there, though, I do want to talk about the impact that COVID has had on this business, on the single family rental business specifically. So Ron, maybe you can speak to, what you're seeing on a daily basis, what we've felt over the past, so it's been so many months now, maybe 6, 7 months, 8 months or so now. Just speak to the impact that you're seeing.
Sure. So I want to clarify something. When we talk about what we're seeing from a COVID standpoint, the impact it has on the real estate market, I'm just speaking specifically to our focus, not the broader market, multifamily commercial. We've seen an increase. If any of you are familiar with the supply shortage right now, as far as housing, I'm not just talking about first-time home buyer or workforce and affordable. There's just a massive undersupply. You also have people who are focusing more on working from home, and they're trying to find adequate housing that can support not being in the office anymore, but also being at home. So what we've seen an increased demand. There already is. We have, and we kind of look to, as our new units are coming onto the market, what's happening. And we're having applications within 24 hours of every unit that we're putting on the market. And we typically have them leased out in less than 2 weeks. And that's more of a screening process and making sure that we're getting the appropriate tenants in there. So whereas there is definitely a negative impact on the broader market as far as commercial, and we've seen it on the multifamily side, we're actually seeing it create more demand for our particular focus.
Well, so I completely agree with that, Ron. I think that the COVID has definitely got people rethinking their living situation. Do they need a bigger house? Do they need another office space kind of thing? Are they teaching their kids from home? All that kind of stuff. So it's got people rethinking where they're at and moving around and job security and things like that. It seems to have people, and just the access to getting a loan and that kind of thing seems to have people leaning towards the rental market. So let's just hop right into scaling that single family business. And like I said, I just really want to stress that we look at it from a business perspective. And I think that that's an important thing for, just a foundation for everybody to come at. So
if I could just interject real quick, Peter. Sorry to interrupt. Just a little pointer. We're getting some feedback in the chat. If you're not currently speaking, if you could just mute your mic so there's no feedback and everybody can be heard very clearly, that'd be appreciated.
Will do. My fault. Okay.
Thank you.
Thank you. So obviously, like I said, there's the dance between having capital to be able to take down the deals that you're seeing, finding the deals that you're seeing, and then being able to execute on the strategy. So maybe it would make sense to explain Well, let's just start with raising capital. So obviously you need to have capital. You need to have access to capital in order to not only start your single family business, but to scale up. So Ron, let's talk a little bit about our different avenues of capital. So we'll call it, capital stack, or there's different names for it, but it involves having different avenues of capital and not being just dependent upon one thing. I think that's a really important skill to have, and relationships to have, and the ability to have. You don't want to be dependent on just personal money. You don't want to be dependent on private loans. You don't want to be dependent on banks and institutions or hard money lenders. You kind of want to have good relationships with all. So we've accessed, all different types of capital, from using our own personal money to leveraging hard money lenders, private loans. We have the funds that we raise private capital through from accredited investors. Wade, you have dealt with many banks and institutions over the years with different structures there. So Ron, let's just start off with just getting started. What's your suggestion? Is it personal money? Is it leveraging hard money? And then how do you, when is it time to kind of scale up? For us, it made sense to start to open funds and have other avenues of capital and things like that. Let's just start with that.
Sure. Yeah, it was a muting there. So if you're just starting out, and I like to tell people I've failed far more than I've succeeded. I think it's important to walk before you run. Real estate can be one of the best investments that anybody can make, but mistakes can also be costly. I think it depends on everybody's particular situation. If you can utilize your own capital initially, I think that's smart. If you're not in that position and you need to use a combination of your own and also some borrow from a traditional hard money lender, very important to balance your exposure. If there's one thing that we learned from 2008, over leveraging can be a bad thing. And one of the traps that I see people get caught in, who for first timers or people who are just getting into the business, is they go straight for the hard money. They borrow 90% of the after repair value, and if the project doesn't go as they would hope it would go, they get caught and they can lose money or not make very much money, or any number of things can happen. So I always really try and drive home to people who are just starting out. Just take it slow. Talk to people who know what they're doing. In this world, there's a lot of competent contractors out there. If that's the route you're going to go, you're not doing the work yourselves. You have to be careful on how you structure those contracts as well. You always have to be making sure you're protecting yourself along the way. It's very easy to get excited about what's in front of you, the project that's at hand. And, even after doing this for over 20 years, no project ever goes exactly how you expect it to go. And, whether that was when I was doing one at a time or doing 50 at a time. So I think it's always important for people to balance their risk. Don't go too fast. Make sure that you get your process down, and then you start to scale from there.
I think that makes sense. It's good advice. I think too, from a capital raising perspective, if you do ever want to move to bringing on private money, opening up funds and things like that, it's just a lot easier to attract the investors and to justify, your experience and that you're going to be able to execute and things like that when you have that track record of playing with your own money and playing with hard money and those different avenues prior to talking to investors and that kind of thing. Wade, you come at it from a little bit of a different perspective, I'm sure. And you do something that I think a lot of people probably find intimidating, or they don't really know where to get started. So talk a little bit about approaching institutions and working with institutions and partnering up with financial institutions and banks and things like that.
First of all, is my sound working this time?
You were good. Yes,
No?
I can hear you.
Oh, I'm good?
You're good.
Okay, good. Yeah, we buy a lot of mortgages. So usually to buy mortgages, you're dealing with larger banks, larger institutions, and it's all a balance sheet issue, really. You have to have an ability to perform 100% of the time. As soon as you falter, you're kind of blacklisted. However, most of the big mortgage traders, institutions that have these defaulted loans, they have boutique shops within their organization. Condor does this, and I buy quite a bit of stuff from Condor, onesie, twosie. But again, it's a performance-based thing. It's a proof of funds type thing, but it's, once you perform once, it's not that difficult to get in and buy one or two loans at a time, if that's your avenue to acquisition. And then it's just a matter of finding the right people to speak to, and I can guide you into some of that. And others of it is just by going to conferences and shaking hands, meeting people. It's not really that big a deal. But the mortgage side is a lot more complicated. It can be intimidating, and I would strongly recommend you have an attorney or some kind of counsel that can help you navigate the due diligence process, so you're not stuck with a note that you can't foreclose, or that's going to take 4 years to foreclose, that type of thing. But there's certainly availability for these types of loans in smaller chunks, 1 and 2 at a time. In fact, I bought one for $25,000 2 weeks ago. So it is possible to get in just a little bit of time, and sometimes that's the best deal. It's the leftovers that a bigger buyer doesn't have time to mess with, that you can get some cherries now and again.
Let me interject there, Wade, because you're making good points and you're kind of hopping ahead to the next topic.
Sorry.
So it's good transitions. But before we hop into that, let's just run over the capital again. So like we said, you have to have different avenues of capital, whether it be personal money. It's always good to have reserves and personal money. So I think that's one of the most important places to start. And then building those relationships with hard money lenders, private lenders, with institutions and banks and things like that. Like Wade said, a lot of it's not rocket science. It's building rapport. It's just the classic foundational stuff of shaking hands and getting in front of people. And like Wade said, a balance sheet. And Ron said it too. It's all about performance and being able to show and track your performance over time. I know in what I do with raising capital and dealing with investors, if you're able to show your performance, that's half of it. You know what I mean? And then the other half is obviously just being a company and people and a team that investors can trust and feel comfortable with, and they find it easy to communicate with. I think all that's important. So that's overall for raising capital. So now you're raising capital, you're thinking about these relationships, you're thinking about different avenues and access to money. So what are you doing with it? What are you using it for? Wade was talking about notes, and we're obviously coming at this from a single family rental stage. So what is he saying about notes and things like that? So before we get too much into that, let's just go over what our strategy is and how we look at acquisitions. So we're moving from raising capital now to acquiring assets. So for us, over time, and Ron and Wade can speak to this just because their careers is long, they've been doing this longer than I have. It's all their experiences and the things they've done have led them to where they are today and the strategy that we have today. And then because we have such a pretty clear black and white specific strategy, and model that we, and assets that we look for, we're able to put our time and our energy and our resources into those specific areas, which is, I think, a very important thing when it comes to acquiring assets and building out your pipeline and things like that. So we invest. We're outside of Philadelphia, so we're in the Philadelphia suburbs. So we invest in the Philadelphia area. We invest throughout New Jersey, and we invest in parts of Maryland. So, I think in scaling up, chances are, depending on where you're at, you might need to move out of state. You might need to look at, for us, we use notes and buying first mortgages, typically vacant, as a way to get to the property. So it builds out our pipeline for rentals. So Ron, just give us a recap of what our model is. Well, we're saying workforce and affordable housing. What do we mean by that? Like, just give me some numbers and things like that.
Sure. We're big believers in staying in your lane, and we have a very specific. Any property that we're purchasing, and this is on average, for acquisition and construction of no more than $75,000, with a appraised value of, on average, $140,000. That allows us to refinance with traditional bank money, and we do. And let me take a step back. We use, as we were talking about in the previous segment, we use all sorts of different capital, our own capital, institutional capital, private capital, to fund our operation. But we always have the refinance component built into our equation, and that's typically through portfolio loans. And we don't ever want to be leveraged more than 70% when we're refinancing. So we always want to be into a property for no more than $75,000 on average, with an average after repair value of $140,000. And when I say property, that's really per unit. So that could be a single family, a duplex, or a triplex. And our model also shoots for a $300 to $500 a month net profit on each door. We really try to stick to that as best as possible, where we do focus on appreciation because it's prudent to do that, but that's not the driving force behind our buying model. And with very few exceptions, we don't deviate from that.
Talk about using notes as a way to get to the property and build out our workforce affordable rental portfolio.
Wade, do you want to talk about going upstream to get notes?
Sure. Yeah, notes are nice because they trade at a significant discount to the stated value of the loan or the stated value of the asset. They do that for a reason, because it takes time to foreclose, time to get your hands on that deed, and a little bit of money. You have to pay an attorney, you have to pay taxes and insurance during that downtime, but it is a way to control your cost basis, because you're buying it, right now, if you're buying a non-performing debt back east, and like in the Northeast, let's say, Pennsylvania, Maryland, you can buy them below 50 cents on the dollar. The problem is it might take you 2 years to foreclose, but that's why you're buying it, at 50 cents on the dollar. Juxtapose that with Texas, where the foreclosure process is fairly quick. You'll pay upwards in the 70s for those types of assets. Typically, a mortgage portfolio, you can pick and choose, which is nice. So you can zero in on geographies that you like, price points that you like, but especially for our rental program, it's nice because there's a pretty significant disconnect, and where there's disconnect, there's opportunity between the large institutional buyers of mortgages and then the small mom and pop shops like ours. The institutional buyers, they're not buying one or two at a time. They're buying $100 million at a time. And when you start dropping below that $100,000 price point, typically that's one of the first filters that an institution will remove from the portfolio. They would prefer not to buy an $80,000 mortgage. And it's just strictly an efficiency perspective. It's going to cost them the same amount to foreclose on a $500,000 loan as it will an $80,000 loan. So when they're buying huge chunks, they're going to eliminate everything under $100,000 to $120,000, which is perfect because that's really where we want to be anyway. And then if you have an $80,000 loan and it's sitting there in Philadelphia, likely I'm going to buy it for about $40,000. Now I have to take the time to get through the foreclosure process, but you'll spend another 10%, 15% on that $40,000 loan. So, maybe you'll end up at $48,000 with a deed. And that's pretty attractive. It's hard to buy real estate in legitimate condition for 50 cents on the dollar. So this is a nice play, but you just have to have a little bit longer runway to get to the asset.
So for somebody that's trying to scale the single family portfolio and wants to bring first mortgages into their acquisition pipeline, what would you say some of the things that they should expect? Because obviously the skill set is a little bit different, but it's similar. Because like you said, you're buying it in the paper position, and depending on where the asset's located, it could be sooner or later, but that you're getting through foreclosure. Being that mostly vacant, and that could be part of the strategy too, is that you because of the way your team and your resources are set up, you want to only look at vacants. I know there's other people that are more on the debt collection side, and that's where I have a lot of experience in that side. Where you're trying to keep the homeowner in the property. Our strategy is a little bit different. We're typically going after vacants, and we're trying to get that rental property at the end of the day. So what are just some things that you think an investor should know if they're thinking about making that scaling to the paper space in order to expand their acquisitions pipeline?
And this is another benefit to the note side and the disconnect in the industry is, again, most large institutional traders, they're white collar. The last thing they want is to actually own the asset. What they want is to just buy and sell paper. So when you start talking vacant assets or lower end assets that are in disrepair, that is all horrifying and well out of their wheelhouse for most institutional traders. So again, those are usually swept to the side, which is great because those of us that are real estate investors, we like to be able to see that asset, and we're very comfortable understanding the risks and the costs associated with putting the property back together. Some trader in New York is a lot less likely to understand that or want to bother with it. Again, when they're trading huge chunks of money, they would rather just trade the paper instead of the physical assets. So again, on the note side, being able to understand the physical asset behind the mortgage is a huge benefit for those of us that are looking to keep the asset as a rental, ultimately, or repair it or for whatever purpose. But if you're really contemplating this into your strategy, like I said earlier, you need a competent foreclosure attorney that can help you due diligence the collateral files. Because the collateral files, and depending on every state's a little bit different, and this is why, again, you need an attorney. But the collateral files are extremely important through the foreclosure process to make sure you have clear title, to make sure you can prove damage and foreclose at the stated mortgage price. And it's a lot of files, but it's very common. That's how we trade them. You get a big PDF of documents, but they have to be gone through. A competent attorney has to be able to say that you have title, or you will have title. You have a path to title. And then you just need the ability and the cash to survive the 12, 18, 24 months it's going to take to get to that process. And mostly it's taxes and insurance. That's going to be your biggest cost up front. You do, once you own the mortgage, you do have the ability to secure it. If it was, if the roof is leaking or whatever, you can come in and patch the roof. But you really can't renovate it or anything like that until you actually have the title. But it's a worthwhile exercise, but you do need your ducks in a row, for sure.
Definitely sounds like you need to be strategic with your capital management. So that's something to if you're looking at doing that, I think is important to be very good at. As like Wade said, it could be 6, 12 months, 18 months or so before you have the property back. And then from there, getting it rent ready, getting a tenant in, all that takes time as well. So all that needs to be factored into the capital management side. And that actually brings up a really good point to why, and to go back to like the impacts that COVID has had on our business. We've been purchasing a lot more real property. It's just, and Ron, you can speak to this. It seems like the market is making more sense for real property. And from a capital management perspective, like we can be 60 to 90 days or so. The property is rent ready, tenants in place, and we're cash flowing already, which is, as you could tell, a lot different from a note perspective, and why it's important, depending on the strategy, to maybe have a balance of the two, depending on what you're doing, that kind of thing. But Ron, just speak a little bit to how COVID impacted our model with buying real property versus notes and that kind of thing, and the opportunities that you're seeing now that COVID's kind of has created, which you did talk a little bit about with supply and demand, that kind of thing.
Yeah, sure. I mean, when I was talking about the supply and demand earlier, that's a supply of finished product, which there's just not a lot of that on the market. Through our various channels, our acquisition channels, we see a healthy amount of product or inventory. And due to COVID, we've actually seen a little increase because there's a number of people who are really not what I would call professional investors. They're doing it. It's not their day job. And whether they were over leveraged or got scared by the environment, they were selling off some onesies and twosies and smaller portfolios. So we actually saw an uptick in the first 3 months of COVID. Some of our largest buying during that period. We traditionally see a relatively healthy amount of deal flow. Just to kind of touch on what Wade's primary focus is on the note side, we look at that as filling up our pipeline for 2-3 years down the road, and we use the opportunity to purchase the real assets currently to fill our short-term inventory needs. But overall, we have not seen COVID affect our buying at all, other than it actually increased it in the first few months. It has absolutely flushed out some people who were concerned about the overall environment. How do they manage their properties? Are they going to be affected by the eviction moratoriums? And they just don't fully understand the entire picture and just felt like it was better to move on. And so again, we found some buying opportunities.
Awesome. Well, that definitely makes sense. And I think, probably that's not over yet. I think we're still seeing a lot of that in the coming months and all as things have been working their way out, but we're still living in that world. So should be interesting to watch. One thing before we move on to executing, which I think is, the bread and butter and a huge, really important, huge part of being effective and scaling up the business. But before we get into that, just talk to me a little bit about the strategy out of state, how that looks from a due diligence perspective and things like that. And for us, we're not, on the other side of the country or anything like that. We're still in areas that we can drive to and be there within a few hours. be back within the same day, that kind of thing. So in keeping things in-house and all, I think that's important for us. But Wade, you've had experience with, in being out of state, doing due diligence on the properties and things like that. Just speak a little bit to that, again, because I think in scaling up, I think sometimes you have to look outside of your area, which sometimes will bring you out of state or bring you further away from your house, that your primary residence than maybe you'd think so. So it could be a little bit of an intimidating topic or something scary, for some investors. So just speak a little bit to how you guys been able to conquer that over the years and feel good about moving into other states and areas.
When we built our first rental portfolio back in about 2002, we had 600 single-family rentals in Houston. They were about 400 in Houston and 250 in Dallas, but that was local to me at the time. I was there, and if I couldn't touch and feel it, I wasn't going to buy it. It was just that simple. So years later, when we started getting into the note business, it was very foreign to me to look at a piece of property in Chicago and trust, I guess, the people I had there looking at the property. It was very difficult hurdle to overcome for me. But it boils down to the asset manager that you're using in that area. If you're unable to be there constantly. And I say asset manager more so than property manager because it's a different type of real estate agent who is used to looking at highly distressed assets. So he's not going to freak out when he walks into a beat up property, but he is key to locate first, that you have an extremely experienced and competent asset manager in the area that you can trust from a valuation perspective, and then also to help you manage your construction over time. But without one or two of those guys, I wouldn't do it. It would just be too hard, unless you can force yourself to be there enough to protect your investment. But a good asset manager is critical. If you go
what's the secret to finding the good asset managers, Wade?
I found almost all of mine just by word of mouth. Guys that I know that are successful in those markets, and you can Google them, but there's a lot of knuckleheads out there. So I want someone that I know that's playing the game in the market, and he can point me to the proper guys. It's really the only way, a good recommendation. And then you got to test them, right?
Yeah, well, and that's definitely. And Ron, you're actually, Wade, you transitioned us again into our next topic, and Ron, let's speak to this. So that's helpful for somebody who's looking to do stuff, to outsource that kind of stuff. For us, GSP REI, we take a vertically integrated approach where we handle all of our construction and property management and all due diligence efforts and things like that all happen in-house on our team. So Ron, you can let's speak a little bit about that, because that leads us into our third pillar, which is executing effectively. That's been our secret sauce to executing effectively. And that's something I think in order to scale up and keep control and keep the same consistency and management and all that kind of stuff, I think it's important to keep things in-house. That's our philosophy, at least. Some people I'm sure can argue that. But Ron, let's talk a little bit to how we operate in-house. Like we said, we're operating in Philadelphia. Our office is based in the suburbs of Philadelphia. We have property throughout the Philadelphia area, throughout New Jersey and Maryland. So just talk a little bit about how we do that and why we do it the way we do it, Ron.
Sure. To make our model work and meet the financial goals that we've modeled for, it's important that we have everything in-house. We have, and I'm going to talk about a couple of different regions, because right now we're working in New Jersey, Pennsylvania, and Maryland. And we have our own in-house construction crews that, and that's not to say we don't sub some things out. At the end of the day, we're not a construction company. We have a construction arm to our business and a construction management arm to our business. So anything within the New Jersey, Philadelphia, Pennsylvania region, our own crews are doing the majority of that work. When it comes to Baltimore, this is where it's important that we have boots on the ground. We have people down there almost every week, our construction managers overseeing subs, keeping everything under our control. All the buying is done in-house, the materials. So we can really cost control, because when you're doing it at the level or the volume that we're doing, it's important that you keep those controls in place. If you're to outsource all of that to a third party, it's pretty much going to bring your cost up by close to 20%, give or take. From there, we have our own asset management. We have our own property management. Our property management is run right out of the home office. We work with different real estate agents in the different regions, but we handle our own leasing paperwork. We handle our own screening. We have a very strict regimented process to how we screen people and the benchmarks we want to see them meet before they become a tenant. That's how we're able to hit the net profit that we strive for. Outsource that? Possible. Say it wouldn't be possible. It'd be possible on one-off cases, but to hit the kind of numbers that we're trying to hit and get to 1,000 units in the next 5 to 6 years, we have to control all that in-house.
Makes sense. Okay. Brian, just is that, I think construction and property management, especially construction when you're moving, out of state or in another area or something like that. I think that can be a very intimidating, I keep using that word, but I think that's what keeps a lot of us from, moving to the next level and scaling, where, from where you are today and where you want to be and that kind of thing. So just, you're very fortunate to have a background in construction, so you feel very comfortable in that space and in that world and speaking that language and all. What would just be your number one piece of advice for somebody who's kind of, who doesn't do that 9 to 5 and is looking to, has their rental portfolio now, but is looking to get to the next level? What would it be from your perspective?
As far as the construction
Yeah.
is concerned, finding a really good general contractor that you feel comfortable with and structuring your agreements in a way that you're protected. I tell people all the time, when I hear about first conversations with different general contractors, and there's a lot of red flags you can look for right away. If they tell you they want 50% up front, there's a number of different things. So doing your due diligence, talking to people who know the construction process, understand building, and really finding the right person and structuring the agreement in the right way where you're protected. And also, when you start getting out of state, and sometimes I think it's more dangerous to try and do 1 out of state than 5 out of state, because if you're doing 5 out of state, you're probably a little more focused than somebody who's just doing 1 out of state. Having eyeballs on your project on a regular basis. And this kind of goes to Wade's point about the out of state asset management. If it's not what you do for a living, finding somebody that can have eyes on your project on a regular basis. And if that's give the property you're going to give them the out on it, the better. And just managing the process the best you can, but educating yourself on the construction process and doing your due diligence on your contractors is extremely important. If you have enough experience to general contract it yourself, and you hire individual subs, I think that's definitely a better way to go. But you have to have enough knowledge about what you're doing to feel comfortable with that.
Sounds good. So I just to kind of recap, being that we're hitting the end of our hour here, first and foremost, coming from the foundation of looking at it as a business, I think is really important. If you're looking to scale up, if you're looking to get to that next level, looking at it from a business perspective is going to be the way to do it, not just a personal portfolio or something like that, but looking at the way that you raise your capital, the different avenues of capital that you have. Relationships has obviously been a theme that's run through the 3 pillars that we talked about today. So, maintaining those relationships on the capital side. I think the biggest takeaway for me was letting your performance speak for itself, and if you can, starting off with personal cash and leveraging some hard money or private loans and things like that, to get yourself started, and then documenting the process and sharing that with people, whether it be through emails, newsletters, phone calls, especially there's so many real estate meetings once COVID's behind us. I know that they'll be all over again, so just, it's kind of like that personal brand, I think, is very important when it comes to raising capital, whether it be through any of those channels, personal money or hard money or private money. I mean, having a strong personal brand, being able to share your performance is really important. Acquisitions, for us, we didn't just keep it to real property. We've opened it up to first mortgages as well. We have, like Ron was explaining, a very strict criteria for what we look for. So that's for us as with the team and the resources that we have and the energy that we have, we're able to really put it into what our bread and butter is, what we're good at, what our team resources are built out for. So having a strong model, something that's been tested to, something that you've worked on for a little bit, it makes sense with the market and the conditions that we're in now and things like that. Is another really important thing for acquiring assets. Maybe moving once you start to build those relationships with contractors and property managers and other investors out of state, maybe moving out of state could be another way to scale or level up. It just depends on what you feel comfortable with and how you feel comfortable with the relationships you have. So that kind of leads us into executing effectively. So just staying on top of everything through capital management, through construction management, managing the project and the budget and things like that, are all things that are going to lead to create the environment that scaling and moving to the next level is going to be very possible doing. So I think that's so there's a couple different ways to get involved in something like this. Like we said, there's that overarching theme of getting with people that are experts in their fields and know what they do and things like that. So just the fact that you're on a webinar like this and that you're using CamelPlan or thinking about using CamelPlan, I think you're all in the right space, and there's plenty of investments that you can look at and things like that. So depending on how active or passive you want to be, we can certainly help with anything it might be with, construction or, questions that you have and things like that. We're available offline, certainly, to talk to anybody and everybody. And we do offer fund opportunities. So if scaling your single family portfolio isn't, in the cards right now, it's just not something you want to do, you don't have the time, or, you want to be more passive or whatever it is. We do have opportunities through our funds where investors can invest in the company. Capital is used to acquire assets, renovate assets. We pay the preferred return monthly to investors, and then it's either a 1-year or a 3-year term. So, and that's all that information is on our website as well. So that's our presentation. I think we got 2 minutes. So if we have questions and things like that, my contact information has been at the top there, just to point to it. That's our office number, 215-821-7030. You can reach Ron, Wade, and myself through that. You just follow the prompts. It rings on our cell phone, so we're pretty open. If you have any questions, you can feel free to reach us on those. My cell phone, just so you have the direct number, it's 610-357-2330. Again, that's 610-357-2330, and you can feel free to call or text me anytime on that. We do have a thing on our website too, where you can schedule time right through the site there. You can see it on the taskbar. And my email is pneill@gsprei.com, and that's Neill, Neill. So I really appreciate Kama having us on today, and William treating us good. If you have any questions or anything like that, we're here for you, and hope we can help you in some way. We'll do our best.
Thanks, Peter, and thanks everybody for coming out today. As Peter said, if you have any questions about what GSP presented today, in specific to the investment strategy itself, you can reach out to them if you have anything about how any of this. If you have any questions, about how any of this applies to your retirement plan or how the process works, please feel free to reach out to me. Again, you can get us at 215-283-2868, or you can email me at info@camaplan.com. So I hope everybody has a great day. Thank you for coming out.
Thank you, everybody. Stay safe.